Issues now. I hope this is coming through well uh, in terms of audio and the video. Okay, today I wanted to talk about the unbanked. Uh, we have about 70% unbanked smallholder farmers that are in the global south. I thought I could take you through a small session that I normally run through a couple of business schools across Asia. I've been teaching these modules at some of the top business schools in Asia, in Singapore and India. But it is more relevant now that we were talking about FarmHawk. So I thought I will share this and see if this is coming around clearly. Today it will be more of how there are a lot of unbanked small farmers in the global south. And again, to give you a perspective about what is global south, we're talking about nations mostly from South America, Africa, India, and all the way up to Indonesia. Again, these are all characterized by lower levels of economic development, historical colonialism, and obviously ongoing struggles with poverty. Uh, about 70% of smallholder farmers are actually unbanked in the global south, which means they do not get direct access to the banks to be able to raise agriculture loans or any credit that they need for working capital needs during the pre-harvest stage. So just take a simple example of a farmer from India. Now he lacks collateral, so he doesn't get clear access to bank credit and forced to borrow from loan sharks at 24% minimum to all the way up to 36%. Now what happens when they go to loan shark is that you going to get upfront internet interest they deduct if they've taken $1,000 loan at 24%. What really happens is that $240 is actually deducted upfront, which means he gets only access to about $760 as a working capital. So this is as if he needs some more funds during any pest attacks or towards the harvest, he would be forced to take some more loans at even higher interest. Uh, Typically, that's what happens on the ground. So the solution or the safety net that we propose using FarmHawk is something called as event-based credit line access, which basically unlocks microcredit based on traceability events. The way we define the events here is that typically a farmer does not need the entire amount on day one. Most banks and financial institutions they overlook this because they really want to give away the entire loan if it's possible, or even the loan sharks. Whereas typically they need uh, across four tranches, which I'll explain. But if we are able to trace all the events on chain and trigger smart contracts to release the tranches, and we will look into this carefully. So what happens in a event-based credit line is that a credit line is already approved, pre-approved from a liquidity pool based on the farmer's KYC and other details. And typically, we run these credit lines through the farmer cooperatives so that it becomes much easier on the risk, de-risk strategies. So here, what's happening is the farmer puts on chain once it is. So we're taking simple things like soil preparation and sowing of seeds and saplings. So the farmer can take 20%. Let's say out of $1,000, 20% is actually given as soil preparation proof. So this is sufficient for a farmer uh, to be able to start the work. After 2 months, when there's growth of the particular crop, then they can take 30%. So when you talk about prorated interest here, what we are really talking is that for $1,000 over 6 months, 20% is what they're paying for the first 2 months. I mean, for 6 months because they took on day one. But this 30% they're only paying for 4 months. So that's a differentiation why we call prorated interest. And this is also good for lenders because there's no initial $1,000 exposure on day one. There's a $200 on day one, about $300 after 60 days. It's probably after 3 or 4 months. If at all there's a pest infestation, we could show this data through FarmHawk, and the smart contract can verify this data and then give out the tranche. And obviously, when they have the entire harvest ready, maybe a week before the harvest, they can take it, which means they're only paying interest for the last 2 weeks of it. So it's again not new, but it says that we have devised this, keeping agriculture in view, and which is very, very relevant. It took us a lot of research to be able to come out with this credit line based event, which will further reduce the cost of capital from 8.8% to probably 6.5%, because they only pay for what to do. If there's no pest attack, they will did not take this 20%, which means they would only end up paying interest for about $700, 30, 300 a year, 300 a year, and then maybe 20. So we're talking about $800 in this case. So that way, the could be stable coins or whatever we have in this liquidity pool now be used to actually lend to more farmers. That's the whole idea. So as I was telling, they give a proof on chain. The smart contract will verify with the data, and then it puts into the farmer's account directly. But again, when there's lending, always it comes with risk management. So that's where we look at uh, FarmHawk as a safety layer for both farmers and also the lenders. First thing is we provide precision agriculture data to the farmers, followed by crop insurance that covers it. So typically, if uh, we lend at 8% from platform, 6% is APY is given to the liquidity pool holders, and about 0.5% is used for insurance and other obviously governance activities, which is still cheaper than 24% they are paying today. That way, we are reducing the cost of capital by two-thirds. We also take care of the fraud detection with satellite imagery. I will try to explain this in the next slides. So today, FarmHawk provides entire agricultural alerts to the farmers on a weekly basis or on a need basis. Typically, we tell them to cut weekly. That will be much easier. So that because the data is actually we're looking at the satellite flies over each country only after every 5 to 6 days. So it's better to check every week, but still we get significant data that they can match against and then take any proactive decisions. The second is obviously the crop insurance. 0.5% is actually paid to the insurers if there is a cyclone, flood, or anything that comes out. The farmer can claim the insurance. Typically, the insurance is paid back to the liquidity pool so that the lenders are not affected, and there's not much claim on the farmer because the insurance would pay for the principal that has been taken and also the interest part of it. Obviously, there could be fraud that could happen. Sometimes the farmers do it wantedly or without knowledge. With these mobile phones having 10x, 20x zoom today, if they want to give a proof and zoom into their neighbor's farm and try to give a good looking picture, that will probably trigger the smart contract to release the tranche. What actually happens here is that we cross check with the data. So you can see that there's not much vegetation on this particular farm. It's almost moderate, and then there's a lot of stress there. So we could actually trigger an alert to a field officer to go and verify manually, which means uh, the tranche, we could actually stop any deferred activities happening on on the platform. So that way it secures the liquidity pool, and lenders are also secured. So that's exactly what I wanted to discuss today, and I hope this is informative for everyone. Thank you.